All right, welcome back to the second lecture video on chapter 23. In the last chapter, we kind of did an intro to performance measurement and management compensation, and then we worked on one performance measure, ROI or return on investment. For this lecture video, we're going to continue looking at performance measures, focus on RI or residual income, and EVA, economic value added. So residual income, hopefully you're pretty comfortable with this. This is the income measure minus a dollar amount for the required return on an accounting measure of investment. So what this means is RI is how much income a division or manager or subunit has after accounting for the kind of the charge that the company overall is placing on their assets. And the charge is this required rate of return. So the company says, hey, we require a 10% return on all the money we give you to purchase assets. So the company gives our division money to purchase assets, and they require essentially a, say, 10% chargeback. This isn't an actual amount that we'll pay them, but it's an implicit interest. And they say we require that, and that way your income needs to be greater than the amount that we charge you. And so it's just what income a division has left over when taking out that interest charge. Like I said, it's the imputed costs that are not necessarily recognized in the financial accounting records, so not in the financial statements. This is just the charge that the company tells the division that they require on all the money they give them to invest in assets. And so, once again, the residual income is just the income a division has left over after accounting for that charge on the money that they receive to buy their division's assets. So this is really straightforward. So let's go through a quick problem. So this is a scenario where uh, you as a division has the opportunity to buy $50 million of equipment. And without the new equipment, this is how your performance looks. You'll have about 45 million in profits. Right now, you have 300 million in assets. The required rate of return that the firm gives you is 10%. So that means every period, essentially the interest that you'll have to account for to the company is about 30 million. So our residual income is our profit that we have left over after we account for that interest. So we make 45 million. That interest that we need to account for is 30 million. So our residual income is 15 million. So now we can make financials that what we think it will look like if we buy that new equipment. Well, we think our profit will go up by what is it, about 5.5 million. So our new profit is a little over 50 million. Our assets will go up by the 50 million of new equipment. And we still have that same required rate of return of 10%. So now the interest that we need to account for has increased by about 5 million. So our new profit with the equipment will be 50,500,000. The interest we'll have to account for is about 35 million. So our new required rate of return will be about 15.5 million. So once we do this calculation, we say, yep, our bonus is dependent on residual income, and it looks like our residual income will go up if we buy this new equipment. So we would say, yep, let's buy it. We're making a good decision. This helps our bonus, and it also helps our firm overall because they would get more of this interest. The division would be more profitable. So it's a win-win for everybody. So we would go ahead and move forward with that project. So residual income, very straightforward. So the advantages, in the last lecture, we talked about ROI, where a division wouldn't want to take on a project, even if it has a really good positive ROI. They may not want to take on that project if it will decrease their overall ROI. So if they already have a higher ROI than this excellent project, even though it's an excellent project, they might pass on it because it'll decrease their division's ROI overall. Well, residual income gets around that. It says anytime the ROI of a project is greater than the required rate of return, now the firm or the division has an incentive to move forward with that project. So as long as it's a positive, the residual income is positive, then a division should move forward because it's adding to the residual, it's adding to the overall residual income. We don't have to worry about a small a project that's not as good as the current projects we have decreasing our ROI, because any positive residual income is a good thing and will take on that project. So it gets over that limitation of ROI. This is pretty interesting that the required rate of return in both of these, it's saying that you can really, a company can adjust the required rate of return. So it can say for different divisions, you have different required rates of return. So maybe for our huge division, the company says, we're going to charge you a higher required rate of return to get you to take on more larger, more profitable products versus a smaller division. And it can also be used for different types of assets. So maybe the firm recognizes that on certain types of equipment, it's just not feasible to get a 10% required rate of return. So for those type of assets, maybe they only require a 2% required rate of return. But maybe on other projects or equipment, they know this equipment is the top of the line. This should really put out value. So will require a 12% required rate of return on those assets. So in general, it's nice because it gives the company a lot of flexibility. Limitations, it really favors large units. Since ROI is a percentage, it's very comparable. So if we have, say, Walmart versus a mom and pop grocer, we can compare their return on investments, because really all it says is, given their level of investment in their assets, how well do they use it? So Walmart should have an incredibly large investment base, but it's all about how efficient they are at using that huge asset. Where the mom and pop, sure, they'll have way less assets, but they could be more efficient. So their ROI could easily be larger than Walmart's. But with residual income, that's not the case. Walmart versus mom and pop, Walmart probably has millions, if not billions of dollars of ROI, where a mom and pop, or not ROI, excuse me, residual income, just because of the nature of the size of the firm. But the mom and pop shop, obviously, on residual income, they can't compete with Walmart. So in general, it's not, residual income is not as great for comparing across companies or across units or divisions or companies because it's not a percentage, so it's not quite as comparable. But it's still very good for incentivizing individual divisions to increase that division's residual income. It's not as intuitive as ROI. Um, and this is kind of what we were just saying, that the smaller you are, the more difficult it will be to often hit a minimum rate of return. And as you get into these small subunits or small divisions, that becomes more and more difficult. But the good thing is as we see over here on the advantages side, firms can adjust for that. So if they are adjusting, that limitation isn't such a big deal. The big limitation is up here in that it really favors larger units, so it decreases comparability. Wow, that writing is terrible, but that says comparability. So that's residual income. Here's a practice problem for you guys. We're not going to go through it because it's for you guys to work on. I'll post